Good day, investors. Welcome back. I'm Jared Bowers. And as we start out today, I'd like to make another quick call for listener questions. If you have any, please send them in. I don't know yet how effective the request from last week was, because that episode hasn't aired yet. And I realized that I didn't say how you could send those questions in. Apparently that might be helpful. But enough of you know me already, and I'm confident that the rest of you are resourceful enough to find the contact email in the show notes, which is feedback@vestadjb.com. I can have high expectations for the listeners of this podcast, right? Figure it out! By the way, teaser, that'll be my answer to every how-to or advice question that you send in. Just figure it the heck out. Okay, now I have a quick question for you. How do you behave as an investor in the market? That is, assuming that you invest in the market in the first place, which I sure hope you do. We'll talk specifically about why shortly. But assuming that you do, and assuming that it isn't your day job like it is mine, there are a number of personality types of stock market investors. Let's go through them together. First, there's the active trader, looking for an edge. If you're not moving, you're sinking. Never saw a meme stock they didn't at least consider buying on momentum. Always just one Reddit thread away from financial independence. Then number two, there's the bipolar panic buyer, panic seller. Always wavering between fear and greed. Feels great buying things when they're going up. Really feels the need to sell when things are going down. Then there's the overanalyzer as number three. Reads every stock report, news alert set on every company that they own, and on every watch list company that they have. But they have a really hard time pulling the trigger because they just don't have all their questions answered yet. But maybe, just maybe, that next 93-page PDF will do it. It'll get them over the edge. Next, there's the set it and forget it investor. Puts money in and kind of forgets it's there. Checks the statement every so often and is pleasantly surprised that it's up, usually, then proceeds to mostly forget about it again. Also routinely forgets their passwords, and as a result, accidentally discovers a very powerful and effective investing strategy. Finally, the fifth investor personality we're going to look at is the buy and hold fundamental investor. Does the analysis, makes the decision, pays close attention, but mostly lets it play out. And there are definitely other personality types as well as offshoots of each of these, but these five capture a pretty big majority of stock market investors. And you may have noticed something about the order of my list. I was definitely going from best to worst. Those poor suckers who are buy and hold investors, man, if they could just see the light and place some more trades and give the traders on the other side more chance to make money off of them, if they could just start using the market as a gambling tool instead of as a company ownership tool, maybe they'd be able to lock in a few more years of having to work the job they can't stand. The dream, really. You better be picking up on my sarcasm at this point. No, the list was definitely from worst to best. Traders and gamblers on one side, business owner investors on the other side. And in some ways, I think that the set it and forget it, forget your account password investors are the ones who are probably the best off. Even above people like me, fundamental buy and hold investors that still pay close attention to all of it. I'm considering it. Although I don't think my clients would appreciate it if I forgot all my passwords and stopped paying attention, but I'm not so sure that they'd be much worse off. If we start out with the right companies, they might end up being better off. All five of those investor personalities that I talked about have access to the same market, the same liquidity, with the same volatility. They have the same opportunity, but their behavior produces very different outcomes, at least on the two ends of the spectrum. Today, we are going to talk through some specific examples, case studies for you nerds, of a few of those personality types, and how liquidity and volatility factor in. Two topics that are a big deal when it comes to investing. But first, let's talk through some principles before we get into the stories. The series of episodes leading up to this one has set us up well for our conversation today. Those topics were on inertia and defaults, rebalancing, and liquidity. If you haven't listened to those, it would be helpful but not strictly necessary for today's topic. We talked in the last episode about what liquidity is. Liquidity gives us the ability to buy and sell. We described it as something that allows us to keep our options open, which can be a really good thing, right? Yes, but not always. When it comes to investing in life, we talked about the importance of locking things in, choosing illiquidity on purpose. Being locked in can be a great thing. We understand that a mix of liquid and illiquid investments in our key areas of life are what likely is going to produce the best returns. We all want flexibility, but if we don't lock in certain key areas of life, we are leaving the biggest and best returns on the table. If we don't put a ring on it, if we don't put down roots, if we live a temporary renter mentality life, the only returns that are available to us are the shallow ones. However, when it comes to our money, that is not the case. I promised you in the last episode that we are going to talk more about money today. So let's do that. When it comes to investing our money, the best returns are still available to us on the highly liquid side. That is thanks to this wonderful tool that we all have access to called the stock market. I'm sure I've ranted at least a bit on this in the past, on how amazing the stock market is, and you shouldn't be surprised that I feel this way. If you think I like rich people, oh boy. How about the thing that has made people rich and still makes more people rich than anything else in the world? With nothing more than having a bit of cash, an internet connection, and pushing some buttons, we all have access to the greatest wealth-generating tool that has ever existed. We get to buy into many of the greatest businesses that exist and be owners, which allows us to benefit from the hard work that other people have done and are doing. And to be an owner of these businesses, we don't even have to ask permission or submit an application or go through an interview process. We just get to. The fact that it is infinitely easier to become an owner of these companies than it is to become an employee of these companies is truly crazy, mind-boggling. And with that ownership, you get the entire might of that company focused in one wonderful direction: to make you money. More accurately, and ideally, to create undeniable value for their customers by solving real problems that then translate into value creation for you as the shareholder. Everyone who works there, from the CEO to the newest employee, their job is to create value for you. You own the same stock that the CEO does. He works for you to make you money. I know I'm starting to repeat myself, but most people don't grasp the incredible opportunity that the stock market affords us. You know how I know that most people don't? Because most people don't participate in the stock market. And many who do see it as something that is risky and needs to be treated like it could bite them. And there is some validity to that. There's the other side to the stock market. We don't just have access to the greatest wealth generating tool that has ever existed. We also have access to the greatest wealth destroying tool that has ever existed. Like all great tools that we talk about, the market is a double-edged sword. But you choose which side of that sword applies. No one else. Used correctly, it is a rocket ship towards wealth. Used incorrectly, it is an amplified casino where neither the house nor the people you're betting against win. You just lose. That is some of what this episode is about. I mentioned the last 3 episodes, but we will also very directly call back to our risk episodes as well. Specifically, episode 18, where I tried about 27 different ways to convince you that volatility is a terrible measure of risk. That's important because I just get to summarize that part right now instead of going through all of it again. Okay, now for the summary. Volatility alone, how much something goes up and down in price, is a terrible measure of risk. Okay, summary complete. But we are going to dig into more of the nuance around that. And the reason that I'm calling back to and reminding us about those previous episodes is that our discussion today lives at the intersection of liquidity and volatility. The opportunities and pitfalls of each are tied closely together, and they affect every person that participates in the stock market. Today, we're going to talk mostly about money. Many of you have mentioned to me how much you appreciate that we mostly talk about investing applied to other things than just money. But sometimes, things are mostly about money, like this episode. It'll be worth it. As I mentioned a couple minutes ago, unlike most investments in life that require a portion of the investment to be locked in, illiquid to get the best returns, that is not the case when it comes to money. The best returns are fully available to us on the fully liquid side, that being provided to us through the stock market. This is a big deal. You don't have to lock yourself in with your money to be able to achieve the best returns. Yes, the best returns are still available to us with fully liquid assets, but that benefit does come at a price. There is a fee. Or you could say it is not free. We pay a premium for this incredible benefit. It's called the liquidity premium. And there's a couple facets of this liquidity premium. The first part is pretty straightforward. You pay a higher price for a liquid asset. Essentially, if you have two identical assets, but one is fully liquid, easy to buy and sell, and the other is highly illiquid, difficult to buy and sell, the fully liquid asset will sell for a higher price. To give you an idea of the real-world magnitude of this, two businesses operating in the same industry with the same product, with the same revenue and profit and everything, where one is publicly traded and the other is private, the publicly traded business will often be valued double, triple, or even higher than the private business. If the private business would be valued at 5 times earnings, the identical but public company could easily be valued at 15 times earnings or more in the stock market. Liquidity isn't the only reason public companies trade for higher prices than private companies, but it is a big part of it. The second part of the liquidity premium is a sneaky and quiet one. And it is the core of our discussion both today and next time. The second piece is this. Being fully liquid gives us the opportunity to do the wrong thing. This is the less talked about facet of the liquidity premium. And you might be thinking, Jared, I have the opportunity to do wrong things all the time, and I still mostly do the right things. So why is this any different? Well, I'm glad you asked. Because a lot of avoiding doing the wrong thing usually comes in two parts. Not having the opportunity to do the wrong thing, and not having the temptation to do it. If you have neither, you're good to go. No opportunity and no temptation. If you only have one, either opportunity or temptation, you're probably still good. Most of the reason we don't do the wrong things in life is because we either don't have the opportunity to, or we don't have the desire to, or we don't have either. I've heard a claim that any guy would love to be part of an elaborate heist. Jewelry, art, bank vault, Ocean's 11 style. Probably because it's been glamorized in books and movies, and it sounds exciting. I don't think this is true, but I thought it was funny when I heard it. And even if it is true, most of us don't have the opportunity to be part of a heist, so therefore we don't do it, even if we had the desire. Ergo, doing the wrong thing successfully avoided. And on the desire side, there are all sorts of bad things that we can do in a given day. We have ample opportunity, but we don't have the desire to do them, so we don't. Again, wrong thing easily avoided. But the trouble comes when you have both. What do we do when we have the desire to do the wrong thing and easy opportunity to do it? That's not a trick question. The answer is, by and large, more often than not, almost without fail, we do that wrong thing. That, my friends, is the other side of this amazing, beautiful, gift-giving market that I described to you just a bit ago. That same wonderful market makes you want to do the wrong thing and gives you the opportunity to do it. Allow me a bit of a digression for a moment. This was a hard episode for me to put together an outline. And I think it's partly because I'm now going to talk us through specific behavior that I've seen, using specific examples. And I think it's also partly because of how behavioral this is overall, and how counterintuitive this topic is. I think it's also challenging because there's just so much nuance to it. We believe and are taught that liquidity is inherently good, and volatility is inherently bad. We've worked through that. We now know that the best returns in life are on the illiquid side of the spectrum, and that volatility is the necessary price of admission to earn returns in the first place. But knowing that, even knowing it and believing it really well, doesn't change the fact that volatility tempts us to do the wrong thing, and liquidity gives us the opportunity to do it. That is the core of our topic today. For the remainder of this episode, I'm going to tell you 3 stories. These 3 stories will look at the temptation that volatility introduces and the opportunity that liquidity gives us to take action, applied in 3 different directions. As a quick disclaimer, any resemblance in the following stories to people in real life is completely coincidental and is only the result of them actually being real people in real stories. Yeah, okay, there is no disclaimer. These stories are not fictional, but privacy will be preserved as best I can. Certain details are going to be adjusted to throw anyone off the scent. But this is going to be interesting. I've only really used general examples up to this point. These are going to get more specific. The first person I want to tell you about is Harry. Harry is a businessman who retired in his late 40s. He was the CEO of a publicly traded company, having achieved that position after working his way up for a couple decades in the corporate world. He had a mix of experience in real estate, agriculture, manufacturing, and a whole lot of business management. His goal was to retire early, and he got there. He retired with a few million before he was 50 years old. And that was back in the 90s. So, 30-odd years later, he's in his 70s now, and he's much wealthier than he was when he retired. His few million turned into a few 10 million. A net worth well north of $20 million. Not because he's been skimping or scraping by since he retired. He lives quite well and has the entire time he's been retired. He's wealthier now because he's invested it the right way. And now I'm going to give you the secret to his success. Get your pens and paper ready. Here's how he handled his investments over the years. He bought strong companies, strong as measured by their real fundamentals, earnings, cash flow, financial stability, and held on to them. That's it. Truly. To be more specific, he hired a financial advisor that did that on his behalf, but he was part of that strategy, fully on board. He only sold little bits of his holdings to fund his spending needs. Otherwise, he bought and held. And they weren't secret, exclusive, only available to rich CEO type businesses that he bought. They were publicly traded. The same companies that you and I have the opportunity to buy and own. And his behavior was consistent and steady. When the market went up, he never got too excited. His spending didn't change much. When the market plummeted, and it has a few times during his 30-plus year retirement, he never got too worked up or worried. If the market was down a lot, he saw it as an opportunity to buy more if he had the opportunity to do so. Remember what I said just a bit ago about the amazingness of the public markets. Harry bought into that decades ago and has benefited massively as a result. What you just heard was an example of near-perfect investor behavior. Not because he was a great stock picker who found the Apples and Alphabets and Nvidias and Netflixes, although he did own some of those, but because he simply did the simple yet effective things right. Also, I should note that Harry eventually became our quintessential example of a good investor. But he did not start there. He had to practice it and learn it over time. Everyone likes to see themselves in the good examples. But when it comes to market participants, those who can invest their own money in the market, there is quite a range of investor behavior and personalities, as we talked about. We can't cover all of them today, but we are going to cover 2 more. Let's talk about the next example. Rodney. Rodney is a fascinating but all too common story of someone trying to shortcut their way to financial success and having the results backfire. Rodney worked in the construction industry as a business manager, and his goal was to retire early. Rodney worked with a financial advisor for a number of years in the past, a really good one, who did his best to keep him on track and on the right path. But Rodney was always trying to time the market. He also had this idea that there were special things out there that if you listened to the right people, read the right blogs, found the right newsletters, that you would find the things that the in-the-know investors had that would allow you to jump in or jump out of different investments at the right time. Rodney's advisor had full discretion of his investment funds, which means Rodney contractually allowed the advisor to invest in what he believed was best, most prudent, without having to consult the client first. But Rodney was a backseat driver when it came to his portfolio. He would be upset when his advisor would sell companies that were going up in value, or when the advisor would buy companies that were down in price. He bought into the idea that companies that were up were good, winners, and the companies whose price was down were bad, dogs. He also thought that it was a smart idea to try to time the market. So he would demand to go into cash when things felt expensive, so he could wait things out and decide when to go back in when it felt better to him. Unfortunately, he spent too much time listening to financial news that was focused on more hype and fear. And whenever the market was at a new all-time high, he'd want to sell. Oh no, when are things going to go down? So he would tactically move his portfolio into cash until there was a buying opportunity. He also, whenever companies he owned were at a new all-time high price, he would want to buy more of those winners. And you're probably noticing a little bit of a disconnect in his behavior. He liked buying companies that were going up in value. He didn't like it when his portfolio was allocated to less expensive, cheaper companies. Yet, when the market was at an all-time high, he would be inclined to sell and look for an opportunity to buy back in when it was cheaper. There were all sorts of ways that this manifested over the years. Contradictory behaviors, conflicting moves, and all this was during a period of time where the market was doing phenomenally well, the past 2 decades. There were some hiccups, but overall, really, really strong returns. And even though his advisor had full discretion of his portfolio, it was still Rodney's money. So as the client, if he demanded that his advisor do something, if he demanded that they raise cash or that they not buy a certain company, or some other backseat driver behavior, they felt like they had to listen. At that point, it's either fire the client or do what he wanted. And doing all these tactical ins and outs, trying to time the market, trying to get an edge, chasing after trendy companies, reacting based on short-term prices, what this resulted in was overall worse returns. Measurably worse returns than other clients that this advisor had that were of a similar risk and a similar allocation. And remember, Rodney was doing all this because he wanted better returns so that he could retire early. But here's the sad kicker. Because he hated his job. He was doing all this to try to achieve retirement sooner, to escape a job he hated. And he wanted to fast track that process. He wanted to find shortcuts. He thought that there were special things that he was missing out on, that his advisor just wasn't finding for him or doing for him. And all that effort, all that time, what that resulted in was a retirement that was pushed further off, due to returns that were not as strong as they otherwise would have been. And at the same time, almost certainly achieving a lower income than he could have had because he was spending his time trying to game the market rather than focusing on the job that he was being paid for. Like Rodney, we all have 3 options for actions that we can take in the market. We can buy, we can hold, or we can sell. What Rodney missed is that the money that you make in the market is not made on the buy or the sell. It is made on the hold. And that is not my quote. That is a paraphrase of a Charlie Munger quote. The late Mr. Munger, if you're not familiar with him, was Warren Buffett's business partner for many decades. And I'll say it again because it is so good and so true. The money is not made on the buy and the sell. The money is made on the hold. Munger said it a bit differently, if I remember correctly. It's made on the wait. And then I will add to it. It is made on the wait after you make a sound, well-reasoned, fundamentally driven investment decision, and then actually put your money to work. Because the hardest thing about being an investor is not so much finding the right thing to invest. In a market that trends upward, that is tied to an economy that creates value with quality businesses that you can identify, which is exactly the world that we live in, identifying the investment is not the hardest part of being an investor. The hardest part of being an investor is letting your investments vest, which takes time. It takes patience. It takes discipline to let them grow, not stepping in and not interrupting that compounding. Rodney and his financial advisor don't work together anymore and haven't for a while. I do not envy the advisor who had to deal with him for so many years. Most financial advisors out there will recognize that this was not a very good client fit, but they'll also recognize that client as a relatively common client profile. You're going to have some of those every once in a while. Rodney was trying to shortcut his way to freedom from a job that he hated, but his avoidance strategy made him more dependent on that job. I have a third and final story for you today. Let me introduce you to Mike and Kim. And if Rodney, who we just profiled, is an interesting but quite common example of someone trying to shortcut their way to financial success and market-beating returns, Mike and Kim are a fascinating and tragic story of how to turn a big fortune into a small one by doing exactly the wrong thing at exactly the wrong time. Not by spending too much money, not by making very ill-timed investments in bad companies, but by doing what so many of us are tempted to do in the stock market. Buy at the top and sell at the bottom. But they did it spectacularly well. And by well, I mean really badly, in terms of the actual result. And I want to make this clear first. Mike and Kim are very smart people. They had been very successful business people. Back in the 90s, they had grown their business for decades to the point where they were worth about $30 million when they sold it just before the turn of the millennium. It always sounds so cool to say the turn of the millennium, but I don't get to say it that often. I didn't have much going on at the time as a preteen, but Mike and Kim did have a lot going on. They built their business, they sold their business, and then they didn't really know what to do with the money. They didn't know much about the stock market, and it felt pretty risky. Kinda seemed like gambling to them. So they just held the cash for a while. But then something happened. More accurately, something was happening. The market, unlike me, had a lot going on at the time. Many of you listening will be familiar with what was going on in the stock market in the late 90s. That was the period we now call the dot-com bubble. Technology and emerging internet stocks, and I will refer to them as stocks, not companies, because most of them were not real companies in the sense that they actually produced something, had real customers, created real value. These stocks were all the rage. They were mostly websites that had nothing more than a lot of clicks, a lot of views. And they were selling shares to the public, IPOing left and right. The internet was a fascinating emerging technology that many investors recognized as the way of doing business in the future. And there was mass jubilation and positive pandemonium about tech stocks that were listing on the Nasdaq Stock Exchange in that time. Companies that fit this category were going up hundreds of percent a day, thousands of percent a month, in some cases tens of thousands of percent. Unfortunately, many of those companies, most of those companies, had nothing fundamentally backing them. No real customers, no real product, no real service, and therefore, very little revenue, or that little mildly important thing called profit. But hold that thought, because we shouldn't concern ourselves with pesky things like a lack of profit just yet. Stocks are flying up, and that's the important thing, right? Which ties back to Kim and Mike. They saw this massive run-up in prices, this market jubilation, and they were feeling like they were missing out. They had a pile of cash that was just sitting there after having sold their business, and they were feeling all the FOMO. They had not been invested in anything for a number of years at that point, and they realized that they were missing out with all that great stuff flying up in value. More accurately, flying up in price. And so, they went into the market. They went all in. $30 million invested at the height of the dot-com bubble. And by the height, I really do mean it. I'm not even sure if they had even a few months of excitement in upward prices before the bottom fell out. And I spoiled part of it already by calling it a bubble, but you knew what was going to happen. Prices fell and they fell a lot. And remember, Mike and Kim were not dumb. Many, maybe even most investors at the time did not recognize those bubble prices. Some did, but there were a lot of people that were going all in at the time. And that is what Mike and Kim did. They went all in, they bought those tech stocks, and those high flyers. Something you should know at this point about Mike and Kim is that they're generally pretty conservative people, and generally pretty nervous when it comes to their money. But they were even more nervous that they were missing out. And unfortunately, they bought in at the top, and they experienced what everyone else who had their portfolio in those stocks did at the time. A very rapid, very steep drop in value when that bubble burst. Terrifyingly steep, terrifyingly rapid. There was a lot of speculation at the time about whether it was a short-lived drop and the prices would bounce back. They hoped that was the case, but it ended up not being the case. At least not for many of those tech stocks. The Nasdaq did eventually recover, but it took a decade and a half. But Mike and Kim rode those prices down in the months that followed the peak to the tune of losing about 80% of their portfolio value. And what they did was at that point, they sold. They got out. They turned a $30 million fortune into a $6 or $7 million fortune. Ouch! And the lesson they learned was that the market is scary, and the market should be avoided. So, from the early 2000s, they left their portfolio in cash. They stayed away from the markets. They thought that they had learned their lesson. They learned that the markets equal danger, so stay away. And they did stay away, all the way up to the point of 2007, where the market was again experiencing a big run-up in price. And this was on a broader scale, not just in the tech-heavy NASDAQ. The market broadly was experiencing big gains. The economy was booming. Real estate prices were through the roof. Everyone was feeling nice and rich, which was translating into really nice stock market returns, which felt great after a multi-year period of pretty stagnant market returns after the dot-com bubble. And at that time, Mike and Kim started feeling left out again. They were starting to feel that FOMO again, the fear of missing out. And their fear of the market turned into greed as they saw the market fly up. And in 2007, they decided to go all in again with their portfolio. They put that $7 million they had into the stock market. And even more of you will be familiar with what happened next. The 2008 financial crisis that lasted for years. A stock market that at its trough lost over 50% of its value. Not just in a narrow sector-focused index, but broadly as a result of the worst financial contraction that we had had in decades. Not only did companies' stock prices go down, but real estate prices went down. Pretty much everything went down. It was a bad time. And unfortunately for Mike and Kim, they again decided to invest at the height and sell at the bottom. They figured out how to turn a $7 million fortune into about a $3.5 million fortune. And at this point, they really did feel like they had learned their lesson fully. Unfortunately, it was a repeat of the wrong lesson. That they should stay completely away from the market. That they should stay in cash. During this time, they had started another business. They had to. They had to keep working. They were living on some of the interest that their portfolio was generating in very safe, stable investments, mostly sitting there in cash. And for the next 6 years, from 2009 to 2015, they stayed out of the market. But that was a period where the market fully recovered, and then did very well. It didn't fully recover from a price standpoint until 2013, a little over 5 years from the previous peak to full recovery, but it did recover. Kim and Mike missed out completely on that recovery. The market was rolling along, but they stayed invested in cash. And it was around that 2015 timeframe that they started feeling again like they were missing out. It was around that time that they also got connected with my business partner, Jason. Thankfully they did, because he was able to point out to them the biggest mistake that they made. You might think that he told them that their biggest mistake was waiting to invest until the high point in the market. No, it wasn't that. It wasn't so much the selling when it was down part either, although that was pretty bad. The biggest mistake they made was not staying invested regardless of the highs or the lows. If all they had done was leave their money put, even in the face of investing at the height of the dot-com bubble and riding it all the way down, if all they had done was done nothing after that point, they would have been just fine. Better than just fine. Yes, it was a mistake to invest at the top. Yes, it was a bad idea to chase a bubble with no fundamentals behind it. But even in that case, they would have recovered just by leaving their money invested in the same stuff. The NASDAQ did take 15 years to fully recover from a price standpoint, but it's up another 3 or 4-fold in the decade since then. And at the time, back in 2015, before agreeing to take them on as a client, Jason went through with them how important it was that they do the right thing, that they listen, and most importantly, that they stay invested. They weather through that volatility, the ups and downs. They were, truly, a bad candidate to be invested much in equities based on their past behavior. But they had expenses. They had a lifestyle that required a portfolio that was actually working for them. And they wanted to retire. So they needed their money to be invested and growing. And thankfully, even if they invested relatively conservatively, their portfolio would be able to sustain them and support them. So after a whole lot of education, after a whole lot of assurances from them that they would do the right thing, and that we would help them do the right thing, which is stay invested, weather through, they really, really wanted to work with us, and we wanted to help them. We wanted to get them back on track with sound guidance, with good management. And so we did. They weren't a large client for us, but we really wanted to help them succeed. And for years, they were nervous. They had a lot of questions. Anytime the market had a little bit of a hiccup, they needed a little hand-holding, and that was okay. But for years, things were going well. They were able to live on their portfolio and see the portfolio grow. Their business was not doing well at the time, so their portfolio was doing double duty. And they were able to just slowly, gradually increase their net worth and live on their portfolio because it was invested appropriately and we were doing the right things on their behalf. Mostly just keeping them invested in quality assets. A $3 million portfolio became $4. A $4 million portfolio became $5. All during a time when they were taking pretty sizable withdrawals from it because they needed to fund their lifestyle. Keep in mind, they were used to living on a lot. It may be hard to believe, but they felt kind of poor having to live on just a couple $100,000 a year. It's true. They used to have a net worth of $30 million. And adjusting down in lifestyle is a heck of a lot harder than adjusting up. We'll have an episode on that in the future, I can assure you. But with Mike and Kim, the plan was working. Things were going well. Until 2020. Now, almost everyone listening to this is going to be familiar with that period of time. The market panic that happened in early 2020 when the pandemic was emerging. A very, very steep and rapid gut-wrenching drop in equity prices. Over a third of market value wiped out in a period of weeks. And Mike and Kim tried to follow the same playbook. They panicked, and they wanted to sell. But we, Jason and I, stood in the way of that. We said absolutely not. Do not do it. And by some miracle, they listened. Looking back, I think the only reason that they listened to us is because the drop was so short-lived. Basically, within a month of the worst price drops, the market started to recover. And then it recovered very strongly, and then it flew upward above previous prices from there. But they finally, for the first time ever, stayed invested and stayed on track. They did not do exactly the wrong thing that the market tempted them to do, and that liquidity would have given them the ability to do. But then, of course, because this is the market, and there is volatility, a couple years later, from the market height of December 2021 through June of 2022, the market experienced a pretty rough patch. Overall, the market was down about 25%. And it was summer 2022 that Mike and Kim wanted to sell again. Their portfolio had gone from over $5 million down to around $4 million. And this was a more prolonged volatile downturn with some steep ups and some steep downs. And it freaked them out. And they insisted that we sell their portfolio, that we get out, that we lock in those losses to protect them from it getting worse. And we did our best to talk them out of it. We had many conversations during that period. We would talk them out of it, they would calm down, then something would happen again, and they would insist that we sell. We would talk them out of it. Eventually, it got to the point where we had to tell them, this is your money. But if you insist that we sell, we are going to have to part ways. We are not going to be able to keep managing money for you. We believe so strongly that selling is such the wrong thing to do that we cannot be part of it going forward. And they said, we understand, you're probably right, but we can't lose any more money. We have to sell. And they did. And we had to part ways because of that. We had helped them for 7 years to do the right thing. We'd helped them grow their portfolio even while living off of it for that period of time. But they were so afraid, they had to lock in those losses. And since that time, by my estimate, they would have been up over 100% from those lows of 2022. But they locked in those losses. They jumped out of the market for a third time at its lowest point. And that, my friends, is how you turn a $30 million fortune into a $4 million fortune. Not by overspending it. Not by gambling in the market. Not by playing options. Not by going to the casino. Not by living beyond their means and overspending. Although those are all pretty sure ways to rid yourself of a fortune. But in this case, it was accomplished by doing exactly the wrong thing at exactly the wrong time, 3 separate times, based on what volatility tempted them to do and what liquidity gave them the opportunity to do. And you know the worst thing about it? I don't have my perfect bottom indicator anymore. It is very selfish of me to admit this, but it's true and it is terrible. I used to have an excellent gauge of when the market had bottomed out. They would call me and tell me that I should sell. My ability to time the market hasn't been the same since. No, actually, getting past my sarcasm, the worst thing about it is that we were not able to help them make the right decision. And you know what's fascinating to me? Well, a couple things. First is what I mentioned earlier. Even given their terrible entry timing, if all they had done was invest at the height of the dot-com bubble and then just leave it there, do nothing, By my estimate, they would be worth over $100 million today. But let's say that they've fully made their first blunder by investing at exactly the wrong time in the late 90s, losing 80% of their fortune, and then selling at the bottom. And then waiting to invest until the height of the market just before the 2008 financial crisis. And I suppose as I talk through that, that's really 3 bad decisions, but let's give them all 3 of those. But then they just stayed invested from that point, from the top of 2007 to today. If they had done that, they would be worth over $30 million by my estimate. And then let's say that they did everything exactly as it played out, but had simply just listened to us back in 2022. Not sold, remained our clients. They would be worth around $8 million by my estimate. And my guess is that they are still worth around $4 million or less. So that's fascinating. The other fascinating thing to me is that I don't think they would recognize themselves in this story. Truly. I'm not sure that good old Rodney would recognize himself either. Actually, I'm sure he wouldn't. Yes, I've kept the privacy of these people intact as best I can, and some key details were tweaked just to be safe. But these are some very specific examples of some very specific people. The first example of Harry, the great investor, could be quite a few people that I've worked with and that I've known. There will probably be a few people listening to this who think that it's them that I'm talking about. One of them is right. But even if those 2 bad stories that I told you, Rodney and Mike and Kim, even if they listen to this, I'm not sure that for a second they would think that I was talking about them. Because those 3 people that I described made poor investment decisions. Hearing me talk through the facts, you can clearly identify those really poor approaches that are holding them back and destroying their wealth. But they will have a view of themselves as the opposite. Nearly everyone thinks that they are the exception. Most of us are not. I've sat across from people as an investment advisor, as a consultant, as a coach, as a school board chairman, and described unacceptable behavior to someone as though I was talking about someone else. And they agreed with me wholeheartedly about how unacceptable that behavior was that I was describing, right up until the point that I made it clear that I was talking about them. It did not go well in most of those cases after that point. Man, blind spots are a hell of a thing. And there is a Mike and Kim, and there is a Rodney inside of all of us. And as I'm talking through this, there's another thing that I realized that fascinates me about these examples. These 3 stories that I told you are not as different as they might seem. Not just because they're all wealthy and they all involve investing in the stock market. Going back to our good example at the start, Harry, interestingly, Harry started out his retired years resembling Rodney quite a bit, at least in a few ways, thinking that there was something special, needing to find an edge, not having the patience to let great companies be great companies, and then have the market realize that and reward him over time. He was a bit of a fad chaser, from what I've heard. But 2 things happened. He got exhausted with it, and he saw the light. He turned over the day-to-day management of his portfolio to a world-class investment advisory firm. You can take a guess at what that firm might be. And he stuck to the principles and strategy that he and his advisors set. That doesn't mean that he wasn't tempted to do exactly what Rodney did. Try to time the market, jump in and out. He still had those temptations. He just found a way to manage them and ignore them. And that behavior is rare, but it shouldn't be. It doesn't need to be. Harry's outcome is available to everyone who starts out investing. The zeros might be different by the time you're 70, but the trajectory is the same, up and to the right. And when we look at Rodney, our backseat driver, he's not that far off from our panic buy, panic sell couple, Mike and Kim. He's primarily motivated by what he doesn't want. He doesn't want to have to keep working. He doesn't want to miss out on special returns. He doesn't want the life he has. And that poor mindset motivation of avoidance has him flirting very close to how Mike and Kim responded when the market goes up and down. Rodney is one bad market drop away from locking in his losses and cutting his wealth in half or more. When we look at the 2 examples of investors who are doing the wrong things, they would be better off doing what Harry, our first investor, did. They would be better off doing less. If they did less or even nothing at all, assuming they were in fact invested, they would be more successful. They would be wealthier. Because they would have avoided doing the things that volatility tempts them to do and that liquidity gives them the opportunity to do. Same market, Same liquidity, same volatility, same opportunity, different behavior, very different lives. We have set the stage for a very important discussion. In the next episode, we are going to dig into the psychology and behavior and temptations that result in these stories and real-life outcomes that we just talked about. Okay, thank you for investing in yourself and in those around you. I will talk to you next time. So, what's my forecast for the next market drop? Easy. A lot of people are going to do the wrong thing.